Hello, everyone, and welcome to this session of Financial Inclusion Week that's going to focus on responsible and inclusive digital financial services. I'm Amelia Greenberg. I'm Deputy Director of SPTF. I am delighted to welcome you today. And I'm also delighted to be joined by my panelists, Ben Wallingford of Incofin and Anup Singh of MSC. So I'll ask each of them to give you a brief background on their expertise that brings them to this panel today. So Ben, why don't we start with you?
Sure, thanks, Amelia. And hi, everyone. Yes, my name is Ben Wallingford. I'm an investment manager in the Africa region at Incofin Investment Management. Incofin is an impact investor with a focus on financial inclusion and agro-food value chain, providing both debt and equity and technical assistance to our investees with over 1 billion USD in assets under management globally. And I'm very excited to join the discussion today, having contributed to industry initiatives in the past around client protection in a digital context and having conducted assessments of digital financial institutions. And also at Incofin, we find the topic really crucial for the sustainability of the industry. And yeah, so happy to be here, and thanks for joining the session.
Welcome again, and Anup, over to you.
Thank you so much, Amelia. Hello, everyone. My name is Anup Singh. I'm the regional head for Microsip Consulting based in Nairobi, look after the African operations. Microsip Consulting focuses on financial, social, and economic inclusion of low and moderate income population in Asia and Africa. Our projects basically focus on supporting the actors to ensure that there is responsible delivery of financial products and services, as well as the non-financial products and services. We have been working for the last few years on thinking about how to bridge the digital divide and support the digital financial services ecosystem and the stakeholders to be able to address the digital divide. I'm glad to be part of this. Thank you so much, Amelia.
All right, thank you. So I will start sharing my screen now so that all of you can see our presentation that we have for you. We called this, sorry, I need to get to the beginning. We call this session the double-edged sword of digital finance because it has great potential to include more people, to make finance more transparent, more efficient, more adapted to needs, but it also has potential to harm. And we have seen some risks and some harm that's already occurred to customers through use of digital finance. So this session today is to talk about both how we avoid the harm and how we do create benefit. You've met us. Overall in the discussion, this is the overview of what we hope to share. I'll start with a presentation of the digital financial services standards, what they say, who they are for, and how we envision implementation. And then we'll have a discussion with my co-speakers about the common risks arising from digital financial services. There are many types of risks, as I will give an overview of in my presentation of the standards. And today we're going to delve into just a few of them, so you get a sense of the details of some of the most common ones and worrying ones that we're seeing in the field, specifically algorithm bias, the digital divide, fraud, and transparency. And then we'll end on a more positive note and talk about the management practices that we have observed that are helping to mitigate these risks and to make sure that the products and services we offer through digital channels are creating benefits for clients. So first, to start with what we call the DFS standards. In order to understand the DFS standards, we first have to understand what the universal standards for social and environmental performance management are. So I think many of you already know SPTF, but for those who don't, we are a standard setting organization, and we created the universal standards back in 2012 initially, and it was a huge global effort to document in one single place our shared understanding of what best practice is for financial service providers of all legal types that are serving clients responsibly. And we organize the document into what we call dimensions, or sort of like chapters of specific categories of management practice. In a recent version, We update this document every 5 years. And in the most recent version, we added a seventh dimension on environmental performance management. So now this document has 7 dimensions, and it talks about all the different management practices to implement in order for financial service providers to avoid harming clients and to create benefit for them. So with the advent of digital financial services, then the question is, do we abandon what we knew before about how to be responsible providers of financial services? Or is it the case where we need to do more of the same in terms of retaining what we already knew about what was good, but adding some additional safeguards because of the additional challenges and risks that come with this new channel? And SPTF has spent quite a long time exploring the topic, and what we have come to understand is that that core of the universal standards remains relevant. It remains important for financial service providers to continue to implement all those practices that we've now known for years are important, but that there are additional management practices to implement in order to be responsible about a digital provision of financial services. And so we have created what we call DFS standards. The document is still in a draft form, and the organization is also still in draft form. But right now we have it in 13 topics grouped into three big categories. The first category is sort of risk management and consumer protection. These are about avoiding harm. And so these standards include those that relate to complaints mechanism, cybersecurity, data rights and privacy, fair and respectful treatment of customers, fraud mitigation, prevention of over-indebtedness, and transparency. And then the second category of standards, I would group more in those that promote benefits for clients. So the first one, managing algorithm bias, really straddles the do no harm and do good, because your algorithm can exclude people, and that's just harmful, but you can also create algorithms that are more inclusive. You can introduce positive bias, like you want to serve women or you want to serve rural customers in particular. And so that can be part of sort of your social goals of inclusivity and extending services to those who previously did not have them. Also practices specific to outcomes, client outcomes management. Product design and delivery is another one that straddles do no harm and do good. You don't want to harm clients with products that are not adapted to their cash flow or their needs. But also, if you have adapted products, you could really have a much stronger potential for the use of those products to help improve clients' lives. And then responsible pricing, the same. If you price too high, you would harm people. But if you choose pricing that is not necessarily profit maximizing, but is more a price that allows the institution to cover its costs and generate enough profit to be financially stable and sustainable while still not being too high, so that customers don't find it onerous to use the products, then that also gets in the realm of both not harming and doing good. And then we have a final section that's collaboration with third parties. So in this one, we talk specifically about agent management, which is a huge part of extending services to those who were previously unbanked, and other types of partnerships, which tend to be more and more prevalent now with digital financial services. So I wanted to give an example of the connection between the base Universal Standards Manual and the DFS standards. You've heard me say that all of the existing practices in the manual remain relevant, and this is an example of that. So we have a dimension about client-centered products and services, and in the manual there is standard 3B, which is the provider's products, services, and channels benefit clients. And within that, there are 5 essential practices. So the standard is a big idea. The 5 essential practices are a little more granular, but they're still sort of goals for what management would achieve. And then underneath each essential practice in the manual, there are multiple indicators that are the actual specific practices to implement in order to achieve the essential practice. And on this screen, I don't have every single indicator for every single essential practice, but you can see that all of these essential practices remain relevant, whether you are providing your financial services through a more analog channel or a digital channel. So specifically, the provider uses insights from client data to design products, services, and delivery channels. The provider removes barriers that prevent access to financial products and services. The provider's products, services, and channels protect clients from harm. The provider's products and services help clients reduce their vulnerability to shock and smooth consumption. And the provider's products and services help clients achieve their goals. So you can see that regardless of your delivery channel, these concepts are still very important for financial service providers to think about when they're adapting their products and services. And then there's just a couple indicators here that, again, are the very concrete management practices. So for example, 3B12 is the provider modifies its existing products and services in response to clients' needs, feedbacks, and outcomes. 3B23 has to do with savings. If the provider offers savings, it sets minimum requirements for your savings balance and conditions about withdrawing savings that are compatible with the cash flows of the target segments. So you can see again, whether it's a digital savings product, an analog savings product, these concepts remain relevant. And then when we did our interviews to understand, okay, well, now that we're in a specifically digital channel, are there other practices to keep in mind if we want to have client-centered product design? The answer was yes. So you can think of that little tiny box. You don't have to read it, but it's the same content we just discussed. That's what already exists in the manual. And then here are some new ideas that emerged from our interviews with experts in our document review. So one is build the digital literacy of your customers enough for them to use the digital products and services that you offer safely and effectively. So this is something specific to digital. Integrate strengthening digital literacy as a part of product design and in multiple stages. So at minimum, when you're onboarding and then offering some refresher trainings. Some advised provide confirmation to a customer immediately after she makes a transaction. This is specific to mobile wallet payments that we've understood that both the M&O and the financial service provider should have some sort of record in their system that a transaction happens and give that to the client. So I won't go through all of them, but again, you can see the ideas that came up in the digital interviews are relevant only to a digital context, but they are things that you would want to think about in addition to doing the practices that are already in the manual. And then here's another example of what's in the manual. And again, we can't read the whole thing, but it is posted on our website. This is partnerships. So partnerships was not a category previously in the universal standards. We, of course, did have client-centered products, but partnerships has really emerged as another area where there can be both risks of harming clients if the partnership is not set up correctly, and also potential to really do good if you have good partnerships that help you extend your high quality services to more people. So here are just some examples. I won't read the whole thing, but again, if you go into the document, you can see them. For example, before choosing your partners, several people recommended research the 3 to 5 most common problems that customers tend to have with any partner organization. And then when you go talk to them about partnering with them, you ask what steps they're taking to address those problems. A second recommendation was if you are in discussions to sign a contract with this potential partner, ask about their client protection practices, and in particular, ask how they receive and resolve complaints, ask if they have a code of conduct policy, and ask how they train their staff on customer care, ask how they protect customers from fraud, ask how they keep client data secure, and make sure you understand the terms and conditions that they impose on customers, because you'll be connecting your customers to them. So on and on, just to know that there's quite a bit of content in this document. We invite you to review it. And now, before I talk more, I'm going to turn it over to Ben, who will discuss this big question of why are we so insistent on integrating social performance management and client protection into digital finance?
Yes, thanks, Amelia. And it's an important question. Our belief at Incofin is that implementation of SPM and client protection appropriately adapted to digital business models allows digital providers to avoid harm to clients while also realizing the benefits and opportunities that are there as a result of digitization. in terms of client convenience and satisfaction, improved institutional efficiency to deliver financial services more affordably to the end client, as well as increased outreach and growth, including in existing and new segments to better meet client needs. And if the products and services are delivered in a responsible way, ultimately a greater financial inclusion. And then the DFS standards can facilitate implementation of SPM to define what are the best practices, what are good practices, to enhance transparency, meaning to have a shared language and standards that the industry is measured against in an aligned way. And then taking those risks and defining solutions or concrete actions to improve practices. And this enables a wide range of stakeholders, such as investors like us, to distinguish responsible digital models. So then funds can be channeled into the most responsible models and companies.
Okay, this is a good time for me to pause and say, if any of you have questions about what you've heard so far, please do put them in the chat box. We're happy to answer them as we go along, and I will keep an eye out for those. But in the meantime, just keep going. A little bit of background on the process for creating digital financial standards. So first, we should mention that Smart Campaign, which has now closed, did a lot of work to create digital credit standards in particular, and those were published in 2019. And that was the starting point for us. So we are certainly familiar with those. In fact, they launched at a joint SPTF Smart meeting in 2019 in Kenya. And those were still in sort of a pilot testing phase. And we spoke with the Center for Financial Inclusion team about sort of lessons learned and ideas about what was and was not working with those standards. So that was the core beginning point. And then we wanted to expand our standards to all types of digital products and services, not just credit, and also to continue sort of the path that Smart had started on, the credit standards of testing and learning. So with that base, we also then did a document review. There are a lot of different organizations that are thinking very seriously about consumer protection, and maybe less so on the do good social performance side, but certainly on the avoiding harm. Many of what's been published are more at the framework or principle level, sort of high level principles, without getting into the very specific management practices to put in place to mitigate risk. Many of these entities that you see here and others whose documents we read also have done really excellent research on risks that they're seeing in the field. So we took all that into account. And then we also did individual expert interviews with about 50 people of all stakeholder types around the world to say, what practices have you seen that are working? What would you recommend based on the risks that you've observed? And so all of that research is the core for the first draft of the DFS standards that were released in February of this year. And then we launched a virtual working group, and we went section by section and worked on each of those 13 sections I showed you earlier, meeting by meeting, to talk about if there were points where our experts were sort of disagreeing about the right way forward, we could hash that out in debate. And then we had a nice full day in-person meeting at the SPTF Cerise annual meeting in Paris just a couple weeks ago, where we got a really excellent additional round of feedback from everyone in the room. So now we're at the point where we feel confident that we have the content, sort of the core concepts that we need to have in order to create a set of digital financial standards, but we need to translate sort of that raw set of ideas into indicators that we can use and put in an assessment tool. So that's the work of the next 3 to 4 months, is to take all this information and translate it into very specific and organized assessment indicators. We'll translate that into French and Spanish, and hope by the end of the 2023 Q1 to publish the standards in 3 languages. And then we will create a simple Excel tool that can be used to assess practice against those standards. And then we will pilot test them in the second, third, and fourth quarters of next year if this timeline goes well. So we're very interested in organizations that might want to pilot test the standards, either integrate them in their own due diligence if you're an investor or a donor, or if you're an FSP and you want to self-assess, or if you're an association that would like to train your members on the standards. We're open to all sorts of partnerships, but the idea is to test them. Eventually, and this is something that came up in our annual meeting, the DFS standards will not be a standalone model. We will integrate them into the universal standards so that there's still a single manual that describes how to implement responsible and inclusive finance, but we'll have some sort of filter or tag so it's easy to see which of the indicators within the manual are relevant specifically to digital. But because so many of them relate to the general management practices about strategy, about governance, about product design, it makes more sense to add them into this model rather than treating it as a standalone document. However, in this development phase, it will be a standalone document. And once we finish the pilot testing and have a revised sort of set of indicators, then we would integrate them into the manual. Okay, so that's the vision. That discussion happened in Paris at our annual meeting. So that's some recent development. Just a reminder, the primary audience for this, we are certainly hoping financial service providers will implement them. We also hope that responsible investors such as Incofin will use them in their due diligence and also sort of to help think about what technical assistance to provide to partners if you do the assessment and you see that they're weak in certain areas. And we're also, along with other partners, interested in outreach to regulators. We want to have a collaborative regulatory environment where the goal of all stakeholders in the digital ecosystem is to promote responsible inclusive finance. So rather than just viewing regulation as a punitive mechanism to de-license bad players, we also want to have sort of a positive conversation of how can we create an environment where it's easy to promote responsible practice, to identify those who are being responsible and ensure that we direct customers to them. And as I said, the pilot testing, that's another topic that we discussed in Paris recently. Please do contact me if you're interested. We are particularly interested in testing this document with all types of financial service providers. So that would include microfinance institutions, but also fintechs, mobile money providers, MNOs, banks, whoever. So if you're interested, again, please let me know. But with that, I'm going to turn it over now to my panelists. We are going to talk about risks of digital finance. As I said, some of the specific risks that our panelists have seen quite frequently, unfortunately, in the field, and sort of their description of what's going wrong and why. So with that, Ben, let me turn it over to you again.
Sure, thanks. And we'll start it off with a discussion about responsible algorithms. One hot topic in digital finance, and for good reason, is of course about the use of algorithms as part of an automated credit scoring for loan decisions. There's the question of how to implement an algorithm responsibly, and about the potential risks which are there. Reliance on non-traditional data sources to assess repayment capacity, such as behavioral factors. This could have a different outcome than a traditional repayment capacity analysis using financial data that could result in, and does result in, overfunding and over-indebtedness, or even underfunding to not meet the client's need. In-person meetings or visits to the business may not be required to verify loan application information. Say in low-touch digital business models with no branches and virtual clients who are engaged remotely, the quality of loan application information could be unverified and lead to a questionable loan decision result. Then about the potential of algorithms to discriminate against protected categories. In some ways, algorithms put a stop to some forms of discrimination. For example, a biased loan officer meeting a client in person. And instead, the algorithm is evaluating each factor kind of on its own terms, the same for each client. However, algorithms also have the potential to exacerbate inequalities depending on which factors or variables are fed into the algorithm. Say, kind of variables like gender or age, something like that. Then high pricing and potential harm to clients in experimental lending phases. In low-touch digital lending, often there's higher prices due to a lack of full information on the client and hence a higher credit risk that's taken on. And experimental lending is about often in the phases of an algorithm deployment. At the beginning, it's needed to have more loan applications to become more effective sooner in predicting repayment likelihood or default. So the threshold for approval may go down in the beginning, or there may be a testing of new variables that may take a more liberal approach to the approval. And in those cases, there could be an issue of the customer obtaining a loan that is not well adapted to his or her capacity. Go to the next slide. Yes, then another key client protection risk in digital lending is on the topic of transparency. And looking at the risks here, loan application and contract may be fully digital, which presents some risk depending on whether the target clientele is well versed with the digital channel or not. A digital design may mean that staff are less available, staff of the financial institution, less available to explain key terms and conditions to the client, either verbally or in person during the application process. One thing is what is on paper, say in a traditional model, or on a screen in a digital model. But what is ultimately most important is whether or not the client actually understands the key terms and conditions or not. Was it more of a ticking the box kind of exercise for the loan contract or other consents, or was there really a full understanding of the terms and conditions? Then user interfaces that require a level of familiarity with the technology used, and digital communications and digital payment receipts, say to check the account balance or perform another type of transaction. It requires the client to have access to those channels, but not only access, also needs to have familiarity and comfort with the digital communication and channels and approach. Otherwise, there are issues from a transparency point of view. That's it.
Right, so we are going to get into fraud and risks with some examples from Kenya, and Anup will walk us through them. But we do have a question already related to standards, and I would like to address it before we go farther. So for the recording, I will read it out loud. Our participant says, I worked on the minimum economic recovery standards, MERS, and contextualizing standards is a tricky issue. What kind of guidance is there on contextualizing the standard for different client segments or the context like crisis or slow onset emergency or migration? So I have some thoughts and I will start, but Ben and Anup, if you'd like to jump in also with some thoughts, please do. I would say that the standards, we always say the standards tell you the what, but they don't tell you the how. So for example, the complaints mechanism is sort of the easiest one. We say you should have a complaints mechanism, and we say you need to tell clients about it so they're aware of how it works. And we say the complaint mechanism can't be too complex to use or expensive so that it's inaccessible. It's to be free and have multiple channels to register complaints. And then we say there needs to be evidence that the financial service provider uses that information to improve its services. So those are all pretty broad. That's the what, it's not the how. So the how is going to depend on your resources, on your group of clients in particular, on what else is happening in your context. So that's how I would say we, in general, view standards. We are not prescriptive in how you implement, and that will change by context. But we try to have at the level of standards these concepts of what you are supposed to be achieving. And the last thing I would say is, in terms of segments, this wasn't exactly the question, but it's worth mentioning that we do talk about segmenting analysis by client groups. So by women, or by rural, or by those of clients who are illiterate versus those who are literate. And that does enable the financial service provider to be adapted in all aspects of its work, and its marketing and its delivery channels, and the structure of its products and the training it gives to its staff. So that it is important, and it is built into our standards, this idea of doing the research, not just once, but on an ongoing basis, to understand the challenges of the context in which your clients are operating. And the pandemic was a really great example, I would say, of a new kind of situation. And we heard from our clients that this, having implemented the standards, not our clients, our community, having implemented the standards actually really helped them because of these big concepts of listening to your clients, using that feedback to adjust your products and services, having a mindset that you're there to offer care, to not harm. It really drove a lot of the then context specific decisions about grace periods or offering emergency loans and that sort of thing. So that's what I would say is the goal of standards, is the what and not the how. And then you do adapt the how based on context. But Ben and Anup, do you have anything to add to that?
I think you covered it very, very well.
Okay, and commenter, if I did not answer your question, please follow up in the chat box. But Anup, let's go over to you. And you can tell me when to advance. I think it says animation, so I'll just move it along as you tell me.
Sure. So I think, I'll like to talk a little bit about the Kenyan landscape and context. And from there, we talk about some of the examples of how the fraud and risks are being perpetrated within the digital financial services, and then talk about some of the problems that we are seeing from the market. So if we look at the financial access that has been happening, and if we talk about the exclusion, number of people who are excluded, it drops quite significantly from 2009, where about 33% people were excluded, to now only 11% people are excluded. And the key force behind this inclusion that happened in Kenya, where now 80% of people are formally financially included, is largely the digital financial services riding on mobile money operations and mobile money wallets. What we have seen is that 57% of Kenyans, as per the FinAccess survey 2021, they had reportedly lost funds, on which talks about the impact of fraud and risk that we are seeing in the Kenyan landscape. This is a significant rise from 8% in 2019. So we have to also correlate this with the COVID triggered digitization, because there were some incentives that the regulators kind of mandated onto the sector. There was a sharp increase in the number of digital transactions, which also meant that there were a significant number of people who were first-time users of digital financial services. And as a result, what we are seeing is that over time, there has been a deterioration of financial health of users. So if I talk about some of the numbers, in 2016, the same research reported 39% of people felt that they are financially healthy. This reduced to 21% in 2019. and this reduced to 17% in 2021. So what we are seeing is that overall, the growth in digital financial services and usage is leading to deteriorating financial health, and there's a direct correlation that is there. Some of the reasons why it is so, I'll talk about some of the aspects of frauds that we are seeing. So the first one is around the unregistered or proxy usage. So 12% of mobile money users are not registered under their own name, and they transact using third parties or proxy SIMs. If we go to the next one, we have the issue of SIM swap, SIM boxing, and identity theft. So a scammer initiates a porting request, and here comes one of the example where an MNO user complained on Twitter, and it was quite uh, quite much reshared within the Kenyan Twitter space, that he had been a victim of SIM swap fraud. One morning he woke up and realized that his SIM card was blocked. By the time he could go to the MNO, the mobile network operator, he gathered that about $300 were borrowed using his SIM card. So identity theft is a big problem. The third issue that we are seeing now is that reversal. So there is, once you're making a payment and you have sent the money to somebody and have taken the delivery of the goods, thereafter you can raise a request of reversal. So 7 out of 10 who lost cash either sent it to wrong recipient who withdrew and refused to refund, and then there are users who purchase goods and pay using mobile money only to request for a reversal of the transaction. And the last one, which has become quite common across most of the emerging economies, is this phishing and social engineering scams, where fraudsters impersonate providers of services or sellers and advise customers about a price or a lucrative offer, and they request to send money to the fraudster number to claim that offer that is there. Lastly, I would like to quote something from Billy Ovino, who is the CEO of TransUnion, which is one of the credit reference bureaus. And he says that lots of people have accessed M-Shwari or Tala, which is basically the digital credit loan, using stolen ID card information. So why is this all happening? And continuing on some of the aspects of other fraud. So we have seen the network downtime, which attributes to the malicious attacks from the distributed denial of services. And we see that the numbers have increased quite significantly. This is a CGAP study, which talks about the global distributed denial of service attacks, which has increased to 13.9 million, a sharp rise if we see from the numbers from 2018. Then we also are seeing the fake e-commerce players who advertise wares on social media. So social selling has become quite a reach. People are creating Instagram, Facebook, and WhatsApp account only to dupe people. Then we are not seeing this only amongst the customers and users, but also seeing it amongst the agents as well. So agent level frauds include the defrauding customers and overcharging them, which is often related to the wrong design of incentives that has been done. Then also agents and mobile financial services providers face fraud, such as the float loss that arises from the unauthorized use, PIN compromise, and impersonation by fraudster who pose as MNO staff, mobile network operator staff, to gain unauthorized access to agent float account and then move money from the float account to their own account. Customers also have been defrauding the agents, so there are issues around withdrawal reverse fraud, where they reverse the withdrawal. So they receive the cash and then they reverse the transaction, or they deposit fake currency. In 2020, a security breach on a consumer finance aggregator affected the bank to mobile wallet transfer, which led to indefinite suspension of mobile money transaction by the largest mobile money provider in Uganda, which kind of impacted several people who wanted to make those transactions during the period when the mobile money transactions was suspended. So essentially, what we are seeing is there are 6 major drivers that are causing digital divide, which is impacting the overall focus on which is pushing people towards this frauds and risks. So the first one, which is a key driver of digital divide, is the inadequate digital infrastructure. So we see that in many rural areas, there is limited or no electricity, which makes powering phones or towers difficult. Even at times, there is no signal to support mobile telephony. And where there is a signal, which is a remote area, it is typically 2G and does not support most financial services, which requires at least a 3G service. The second one that we see is the lack of the adult literacy rate. While it has increased globally, it remains quite significantly low in sub-Saharan Africa and just below 60% in low-income countries in sub-Saharan Africa. There are about 100 million youth who cannot read. So this is causing a lot of issues around understanding of financial services or digital financial services. In terms of the trust in personal relationship, particularly when it comes to money, most of the low and moderate income population do not trust technology that they do not understand, and there is very limited effort that is being done from the mobile network operators or digital financial service providers to ensure that their understanding can be increased or enhanced. We can keep going to, maybe you can run the full animation. I'll keep talking through some of the points. Then if we talk about the smartphones, so among poor households, including the urban ones, there are few smartphones, and even the feature phones are largely owned by men. And then there is lack of customized products and services offered by FSP, specifically around interfaces, which Ben was also talking about, or the use cases for low and moderate income market. And in most of the emerging economies in Africa, what we see is that the regulatory environment and customer protection provision continue to remain too weak to provide any security to the low and moderate income population who are significantly vulnerable. So in this slide, essentially what we are doing is we are correlating how these drivers of digital divide essentially relate to the fraud. So if you look at the aspect of financial illiteracy or orality, unfamiliarity with using digital financial solutions, and lack of smartphone ownership, so there are individuals who are vulnerable and susceptible to falling prey when engaging with fraudsters. On the weak regulatory environment and poor customer protection, so fraud victims cannot get the support they require, and hence they incur the financial loss and they have to bear with it. And that results in negative word of mouth publicity, where they keep talking about once somebody has gone through a fraud, they then begin to discourage other people to also use digital financial services. And this trust that is required on physical actors. So there are instances where we have seen that individuals were manipulated into undertaking actions that led to financial losses.
Okay, so we're gonna, as I promised, we're gonna end on a more positive note and talk about some of the solutions. But before we get there, we have another question, and Ben, it's for you. So let me read it for everyone's benefit. And then Ben, I'll turn it over to you to answer. The question says, when you talked about algorithm bias, I'm wondering from the perspective of an impact investor, what are the points of influence you have on fintechs and their data science teams, and how far can you go in terms of influencing their practice?
Yeah, thank you, Alex, for your question. In terms of investments in digital lenders, it's still fairly new for Incofin. We invest in some digital financial service providers, also P2P lending models. Many of them are equity stakes, so we ensure to have a board seat and then having a lot of say in decisions and influencing the practices. But it is a key part of the DD and monitoring about how the algorithm is designed from a CPP perspective. Of course, it's not an easy topic because of the technical data science knowledge which is needed to assess some things, and also often providers initially not wanting to share some details about the algorithm that as it's deemed to be proprietary. Well, it is proprietary, and yeah, that leads to less openness to share. But it's important to press to understand what kind of factors and variables are the main ones used. Are there some factors that are excluded? How is the algorithm aligned from a governance perspective? And also if they look for correlations between discriminatory and a non-discriminatory variable, which I'll get into on one of my next slides as well. Yeah.
All right, so why don't we just go right into it? This is a good segue. So you talked about the risks earlier, and then now, and Alex's question sort of leads to one of the solutions could be using influence in a positive way when you're an investor. But Ben, back over to you for the explanation of these points.
Yes. Yes. So now to talk about solutions to the risks highlighted earlier, some reflections from our experience. First is on the topic of responsible algorithms again. So yes, for loans, large loan sizes, a higher touch or hybrid model can often be the most ideal design. Thinking back to the 5 C's of credit, that to really know the capacity and the character of the client, that a human interaction and viewing the business, in the case of a business loan, can be important to gain the trust needed to offer larger loan sizes and limit credit risk. And this can be while maintaining the use of an algorithm, but complementing with interaction, the essence of combining tech with touch, we could say. And especially for larger sizes, it's often needed to have income and expenses and other loans to really understand the disposable income of the client. Whereas then for smaller loans can have some proxies of income or financial factors, could still be effective. For example, using transaction data like mobile money, if the ecosystem has mobile money in it, or credit history. Then about algorithm design, that it should be documented and variables reviewed for alignment with the strategy and the mission. So this is on the topic of algorithm governance, that it's important to look at the mission of the company and to what extent the algorithm and its outputs are aligned to that mission. Say if the institution has a focus on rural clients, but the algorithm favors urban clients, then there's a mismatch. Something needs to be adjusted. And then even outside of that discussion on, say, social goals and matching that, some protected categories should arguably not be included as factors. And we've seen providers do that, where there's certain protected factors not considered by the algorithm to equally treat, for example, women versus men. Then to take it a step further, there could be a check of correlations between a variable that doesn't seem to be discriminatory, but could be linked to something discriminatory. And a common example of that is location, that at first glance doesn't seem discriminatory, but it can be linked to some aspects that should really be treated equally instead. Then tracking effectiveness in repayment likelihood over time, and that pricing strategies should reduce pricing over time. As the algorithm becomes more reliable in predicting repayment over time, the benefits of that should accrue not only to the institution, but to the client as well. And we've seen institutions that deliberately have this as the plan in the form of lower pricing for clients with good repayment history over time. Go to the next slide.
Yeah, before we move on, I just wanted to say that this was a really fascinating area of discussion when we were developing the digital financial standards. And I'm thinking of the earlier question about adapting standards to context. There was sort of widespread consensus, which wasn't always the case in each element of the standards, but in this one there was, that if you don't have the data science sort of ability on staff to assess the code of the algorithm, or if you have a partner that doesn't want to share how its algorithm works with you because it's their proprietary tool and they don't want to reveal how it functions, that nonetheless the financial service provider has a low tech but effective way of assessing algorithm bias, which is just to take a sample of data and assess the decision, like make a decision on who gets a loan, for example, and in what size, based on your analog old system, and then run it through the algorithm and look at what the algorithm chooses. So without understanding the coding, you can say, okay, well, when we did it with our old-fashioned system, 50% of the women who applied got a loan. And when we use your algorithm, only 20% of the women applied who got a loan. So there's something wrong. So you can have that kind of conversation, and our standards do say, our draft DFS standards say you should, and you don't even have to use real data. If there's any sort of problem with using actual client data, you can just have a manufactured data set and see if you use your old system of analysis on the old data, whether you would get similar results or different results from the algorithm. And then you can work with the provider to adjust it until it's making the decisions that you would want it to make, even if you never understand the technology. So it doesn't have to be like you don't have any governance and control, even if you aren't a specialist in this kind of technology. And the other thing I wanted to point out was something really important that Ben just said, algorithm governance. This is an example where we are going to probably integrate most of our algorithm DFS standards ultimately into the governance section of the universal standards, because this is an issue where at the leadership level, you have to set your priorities. Do we want to be serving rural clients? Do we want to be serving women? What is our definition of a fair result from an algorithmic analysis? And then it would also be the responsibility of your governing bodies to monitor whether the algorithm is making decisions that are aligned with your social mission or not. So it is a governance issue. It's not a separate tech issue. And it's important to think of it as something that what the management has to engage on, even if they aren't themselves algorithm experts. But with that, let's keep going. I will advance the slide.
Good. So coming back to transparency, some best practices observed are to disclose key terms and conditions accessibly during the loan application, provide clients with easy access to key information through a channel that's appropriate to the target client. The most important word here is accessible, that if the clientele is comfortable with the mobile app and they have a smartphone with consistent internet access, then that can work. If clients as an application, if clients have basic phones and not internet access, then USSD or some other basic phone technology or SMS could be the design. Then provide clients with an effective channel to ask questions and receive additional information from a live customer service staff prior to agreeing to the terms and conditions. For clients that are less comfortable with digital channels, providing key information verbally or asking probing questions to confirm the client's understanding can really be essential to make sure that the client really understands the main aspects of the loan. And then payment receipts provided digitally for free through an appropriate communications format based on client capability. So on the topic of payment receipt or other account activity, the client should receive notifications about that at no charge, and receipts could be on email if it's appropriate for the client. And also there's client feedback that the institution has gathered, which shows that is the case. Otherwise, some other form of receipts like SMS would need to be used to. So yeah, summary of this slide would be to really adapt the approaches of the loan application and providing information to the client before and after the loan to the capabilities and preferences of the clients themselves.
Anup, over to you. And everyone,
Thank
just a
you.
quick time check. We have 8 minutes left. So if you want to ask more questions, now's the time. But Anup, keep going, please.
Okay, thank you so much. I think rather than reading the words that are there on the slide, I would like to talk about the conceptual aspect of how some of the examples that we are seeing are bridging the digital divide to reduce the instances of fraud. So essentially, it is centered around 4 key areas. The first one is building use cases that are closely related to the real economy needs. So whether it is agriculture, whether it is financial services, health, education, e-governance, centered in and around the customer's ecosystem and vicinity where they're operating. The second thing is combining the tech and touch. So here agents could become a key reckoning force, so to say, to be able to support this. So agents could become the assistants and mentors for those who are seeking to access products and services, as well as also to enable them understand the nuances of products and services, the aspects of what we call the financial education, financial literacy, and digital financial capacity. Then the third aspect that we are thinking about is having the customization or tailorization of products and services. So how do we use the customer-centric approaches to develop tailored digital products and services, and also ensure that these products and services are people are able to use it. And fourth one is the capacity building of the users. So can we utilize the aspects of platforms and think about a range of digital and financial education modules, which can be in bite-sized pieces. One of the things that we saw working was some of the institutions are trying to have metered access to internet through tablets and smartphones, which the rural population can use. Now, interestingly, even the tablets and smartphones are subsidized commodity that are being provided to the users so that they can be able, they can effectively understand how to use them in their context and are able to utilize the application that are being developed around the financial literacy and financial education. So that's what we have been seeing working. And these are some of the examples. So we have seen financial institutions in Kenya are utilizing public awareness campaigns to fight fraud, because yes, fraud is a big issue. And even central bank is also supporting these institutions and coming up with alerts. Next slide. And the last one is that Safaricom has also invested quite significantly in educating customers and agents on how to combat fraud. We'll be sharing this deck, so you can take a look at the video that is embedded within this deck. Thank you so much, Amelia. Over to you.
Sorry, everyone. We have just a few minutes left. I was going to have our panelists just think one sort of closing message to leave you with, and we will do that now, but also final call for questions or comments if you'd like to share. So I'll keep an eye on the chat box. But I did want to tell everyone that our emails are at the end of this presentation. So this is going to be posted on the Financial Inclusion Week website, and you can contact any of us at any time. There's also some information in the back here, an annex on what we do if you need that information for what you're working on yourselves. And so we hope you do reach out to us. But to wrap up, I would like to ask each of the panelists what's sort of a closing message. And for me, it would just be that we do think there are solutions to the risks that we are seeing, but we also feel that everybody is exposed to these risks. That's the takeaway. It's, fraud, as Anup has explained, is a huge problem. Transparency is a problem. So I think it is irresponsible of financial service providers not to really be deliberate about managing against those risks. And so I would encourage everyone in this ecosystem to look at the standards and do sort of a serious self-evaluation, because this is happening more and more, as Anup's data also showed. And it's really a moral imperative, I think, to take proper steps to combat it. So that's my message. And Anup, why don't we go back to you?
Thank you so much. I think I would like to summarize that as we are thinking about financial access, of which because of digitization, it has really enhanced financial access, we should also start thinking about the quality of products and also the financial health of the users who are going to use these products. Because if one is impacted because of the fraud and the risks that are associated with digital financial services, it's very easy to lose money in bits and bytes now in the form that we are having in terms of the digital financial services. So we need to, as the stakeholders of this ecosystem, as proponents, whether it is financial service providers, donors, investors, and other organizations, we need to double down our efforts and investments into thinking about how do we impact financial health positively, not negatively.
Okay, and Anup, I'll stay with you just in 30 seconds. The question is, do you think that the risk of fraud will reduce over time as customers become more savvy users of technology? Or do you think fraudsters will continue to evolve their tricks, and so this is going to be as big of a problem in years to come as it is right now?
Great question. I think this is the typical, thief versus police kind of a case. So the fraudster will also evolve as we are thinking of users evolving. So we'll have to start thinking about how faster we are able to evolve users so that they can be safeguarded from these kind of risks.
Okay, and Ben, over to you. I'm getting a message. We have 1 minute, so 1 minute to close, final thought, and then thanks to everyone.
Okay. Yes, I would say digital finance is not all good or bad, just like the more broad financial inclusion industry. Some models and companies are responsible, others not. And adapted SPM and client protection standards are useful to assess whether a company is operating responsibly. So let's distinguish between good practices and bad practices and take action in our respective organizations to encourage the better practices to grow.
Okay, that's all for today. Thanks so much, everyone, for your participation, and we hope you stay in touch. Have a great day, everyone. Goodbye.
Thank you, everyone. Bye-bye.
Thanks, everyone.